So everyone, now without further ado, we'll start the third day of training and welcome our speaker, Regina Rosman, working for Convergence. We will conduct you through blended finance this morning.
Thank you and good to meet you all. Some of you I already saw yesterday at the networking reception. What we will do in the next little while is we will go through a few concepts and case examples of blended finance for renewable energy. I'll start with a few slides just to set the scene. Then we will go into small groups to reflect on some case studies that you have worked on. Then I'm going to present some of the market trends in blended finance using some data from Convergence's database. And then again, you will have time to talk to each other. So I'll be speaking for maybe 40% of the time and you will be speaking for 60% of the time. So even if you didn't have a coffee, hopefully you can follow and stay with me for the whole time. So just as a recap, I imagine you all have seen blended finance. I know Laurent mentioned it also in the earlier slides, but just as a framework, if you think about why we need blended finance, it is because we're trying to bring in additional private capital, right? And so what you typically have in a blended finance structure, whether that's a project or a fund or facility, is you have some concessional money that's deployed on below market terms, whether as the grant funding or as a zero interest loan, for example. And that concessional money then mobilizes the private capital into the structure. And the idea is that most likely this private money would not have been mobilized if it wasn't for the concessional capital. Now, why do we even need blended finance? Because a lot of times projects would not be viable before blending. So they would be unacceptable to private investors. That can be for various reasons. It could be because of high counterparty risk, it could be because of high construction risks, or whatever types of risk, right? There's lots of risks. But what blended finance can do is it can move a project in this capital asset pricing model either to the left, so it can reduce the risk and thereby move it onto the market line, or it can enhance the returns moving from A to C, right? So there's two ways what blended finance can do. It can either de-risk, moving it this way, or it can return enhance. And thereby it moves it onto the line whereby private investors are comfortable with it, right? And so a lot of times, if you look at our database of blended finance transactions, most projects actually are rather on the de-risking side than the return enhancement. That's also because the concessional money a lot of times comes from governments. And as you can imagine, governments really don't like the idea of juicing up the returns for private investors and, subsidizing private returns for, the bankers that already have a lot of money. So in terms of perception, it's much easier to sell to governments that they need to de-risk rather than return enhance a project. And so in the end, what we're trying to do is we're trying to get a project to a level where private investment can flow to those projects. I'm going to spend quite some time on this graph because I think it's a good one conceptually. What this picture shows you are the different types of blended finance. And down here, this percentage number, I'm not sure if you can see it, this percentage here shows you how common this type of blended finance is in the market. So the most common type of blending is whereby concessional money gets inserted directly in the capital stack. This is very common in project finance, is that the concessional money is inserted directly either as junior equity or as flexible debt, for example, and then you create what looks like a layered cake, right? And so basically, you can think of the gray money here. Gray always shows concessional. The gray money is like a risk cushion. It protects the private investors. So for example, the senior debt holders here, they sit on two risk cushions, right? So they should be very comfortable. They don't need to worry too much about not getting repaid, for example. There's lots of examples for this type of structure. One is the Mirova Gigaton Fund. We'll hear later on from Sébastien Duquet. He'll be on the panel later on, so I imagine he's going to mention it. There's also the Responsibility Asia Climate Strategy, and I also have some examples for projects that I'll walk you through in a minute for this type. Now, what's also very common in the energy sector is guarantees, and actually increasingly so. Guarantees have been more and more common over the last couple of years. So a guarantee is a risk reduction tool that protects investors against capital losses. You might be familiar with the European Commission, which has what they call the EFSD Plus program. So that program allows some development finance institutions, such as KfW, to give guarantees onwards to projects. The African Guarantee Fund is an example for an intermediary that is involved in guarantee provision. And in the end, what this guarantee does is it takes away some of the risk from the commercial investors here. And so those guarantees are very common also in the market, about 30%, and this has been increasing significantly. The third type of blending is what we call design or preparation funding. This is less common, only 13%. And what you basically do with these grants is they come in before the project even exists in order to structure the vehicle. So this money can pay for legal costs, for example, to set up an SPV, or it can pay for the investor roadshow that you're conducting. And an example is IFC's Scaling Solar program. And then the last type of blended finance would be technical assistance funds. I imagine you are well aware with those because they're very common amongst development banks. These are funds that supplement the capacity of the investees. And so this technical assistance money can, a lot of times it goes to the project itself. So for example, to train the people who will later operate the plant, for example, or to provide support to the organization that's running the plant to do the environmental reporting, right? So because a lot of times the DFIs have very stringent reporting KPIs and the local staff might not be able to do that. And so by subsidizing this through a grant, you reduce the burden onto the operator. For example, if you're trying to calculate emission reductions, right? Like the local team might not have the capacity, so you can, support them with a grant. And thereby you don't force them to use their own funds and time for that. One organization that does a lot of this technical assistance funding is the Private Infrastructure Development Group. They do it, for example, through InfraCo Africa or InfraCo Asia, or through the Emerging Africa and Asia Infrastructure Fund. Yes, and we'll look at an example for this also in a minute. It's interesting also for you all to think which of these types is most useful in your particular context, because each project is different, right? You might already have enough senior debt and enough commercial investor interest to start something up, but you might just be worried about the reporting that that plant initially would have to do, right? And so in that case, maybe TA is the part where you would be willing to do blended finance. We'll also, in the small groups, we'll reflect back on this in a second. Now let's look at a few examples so that this becomes easier to digest. The first one I have here is from Malawi, from the Golomoti Solar project. This is an example where the Private Infrastructure Development Group got involved through InfraCo Africa, their African subsidiary. And basically they provided early stage equity to develop and de-risk the project and making it more investable. And that was needed because there was no example of a battery energy storage alongside a utility solar PV in sub-Saharan Africa and in Malawi specifically. And so this was a first mover transaction, right? And first mover transactions are super difficult to finance because usually the banks and the local investors don't know how to think about it, right? They can't really place it within their own structures. And that's where an organization like InfraCo Africa, which has some concessional equity available, can be really important as an enabler to get that project off the ground. This transaction was relatively complicated. You see there's a lot of organizations involved. And so you can imagine how difficult it was to coordinate all these different partners. Just to give you an idea of who all was involved, there was a political risk insurance from MIGA, that's the World Bank's entity for insurance and guarantees. There was also a partial credit guarantee from ATI. And then there was donor grants also from USAID and from the UK government to support the development and fund the batteries. And then in the end, once the project structure was validated, they were able to attract private equity and also development finance. And so in this case, because it was such an early project and a first mover, it was really important that blended finance can absorb those risks and demonstrate the commercial viability. And so it became one of the first battery energy storage systems. Let's look at another example, which is in Vietnam, the Bac Ninh Waste to Energy Facility. This is an example of concessional capital being directly inserted in the capital stack. And it involved IFC and what they call the Blended Finance Climate Program, which is a partnership between Finland and IFC. And so this Finland IFC Blended Finance Climate Program was the provider of what we call the concessional senior loan. Within this concessional capital slice, the majority is actually deployed as senior debt, and that's very common for the development finance institutions. On top of having this concessional loan, they also had a subsidy from the Japanese credit mechanism, which is about carbon credits, basically. And then the rest was covered through sponsor equity. And so I'm going to explain in a little bit why the Finland IFC Blended Finance for Climate program was so important in this particular project. First of all, where is it located? It's in one of Vietnam's really main industrial zones, which has a lot of waste that it produced. It was collecting the waste, but it wasn't really disposing the waste off very effectively and sanitary. And so there was just a lot of landfills that weren't doing their job. And so what's interesting to note in this example is the trigger to the idea of a waste-to-energy facility even being born was a change in regulatory environment. In 2014, the government of Vietnam introduced a feed-in tariff. So there was a feed-in tariff of 10 cents per kilowatt hour that was available, and that was meant to increase the attractiveness of waste-to-energy plants. And so I'll show you the structure. Don't worry, it's a little bit complicated, but we'll go through it slowly. And so in the end, there was a Vietnamese company, this one, Tuan Tan, which had already been established in Vietnam, was doing a lot of business in waste, but did not have any exposure to waste to energy. And then there was a Japanese engineering company, which was a leader globally in waste to energy facilities, over 260 facilities, over 80 of them abroad already being part of their portfolio. And also waste to energy facilities were their biggest line of revenue. And so this Japanese company approached the Vietnamese company saying, why don't we enter into a joint venture so that we can build a plant there? And so they entered that joint venture and started applying for a grant, for a subsidy from the Japanese government. So the joint venture, you can see it here, 45% of it is owned by the Japanese company and 55% is owned by the Vietnamese company. And so they applied for this grant and they got a grant, substantial one, over $15 million US. And this, so basically what this grant is, it calculates the emissions that are being reduced through this plant, and then it splits them up into some of the emissions that Japan can take credit for, and the Japanese company can count towards their emission reduction targets, and then some of it the Vietnamese company and the Vietnamese government can take credit for. And so basically through that joint crediting mechanism, there is then a payout from the Japanese government to this company for reducing those emissions. That's the idea. So they created this joint venture, and then they started talking to lenders, and they approached IFC and said, don't you want to help us by financing the plant? And so then IFC said, fine, but we need a corporate guarantee from the Japanese company because this one's credit-worthy. And so the Japanese company says, well, no, I only own 45% of the joint venture. I'm not going to, give you 100% corporate guarantee, right? And so that didn't go forward. Then they were like, okay, maybe we can do a A loan, B loan scheme. Maybe we can bring in some of the commercial local banks. And the banks were like, I have not seen any waste to energy facilities all over Vietnam. I'm not going to give you any money, right? And so commercial local banks were out. There's no way to get that in. And so that's when IFC started looking at this Finland IFC Blended Finance Climate Program. And what they came up with is quite smart. What they did is they divided the corporate guarantees into two. The IFC A loan, which was about 15 million, went to the Japanese company. So IFC got the better credit-worthy organization underneath. And the Finland IFC Blended Finance loan got a corporate guarantee from the Vietnamese company. And so the Vietnamese company had higher risks because it was operating only in that one area of Vietnam. It had not that much experience in running and so on. But it was fine because this program itself is meant to take risks, right? So it's very rare that it would actually take recourse against the Vietnamese company. And so by splitting up the corporate guarantee, allowing IFC to have recourse against the Japanese company, they were able to manage the risks and the return expectations of either. Originally, they planned that this loan would have been on concessional terms, but because this Japanese subsidy ended up being so high, they actually cut this deal also on the same terms than the IFCA loan. So in the end, it was not priced concessionally. Let's go back to this example. So it was priced at market rate, also at 10 years, but because it only had the underlying guarantee to the Vietnamese company, it was still absorbing higher risk, right? And so we still would consider this IFC loan, this blended finance program loan blended, like concessional, although it was actually written on market terms, right? And so this was how they went forward. The construction took about 2 years. And what's interesting is, once the plant was constructed, this JV then approached some of the local domestic banks and said, would you be willing to refinance? And the banks were, yeah, of course, no problem. Now that the project is there, now that the plant's operating, now that you can show me the financial model, I'd be fine. And so they were able to refinance the blended finance loan here with local domestic finance. And so that's how you can see that sometimes the mobilization isn't direct, but rather indirect, right? Originally, the domestic banks had no interest whatsoever. And then after this was built, after construction risk was mitigated, they were fine. And what's also interesting is a lot of times the international lenders are much more worried about, the local, the country risk, regulatory things. The domestic banks didn't care because that's their daily business. After all, they're based in Vietnam, so like any loan they do has that risk attached to it, right? And so it just shows how if you approach the right organizations at the right time, you can really make a difference. So that's one example, right? What are the takeaways? One is, without that feed-in tariff of 10 cents per kilowatt hour, it would not have gone through. They entered a 20-year power purchase agreement with the national utility, so basically any energy produced by the plant went back to the national grid for that feed-in tariff that was agreed upon, and that provide the revenue streams to also secure some of the cash flows. And also the domestic banks then refinancing is another interesting example. Just as much time on this example, but we'll go through it still. This is an example from Latin America, from Chile. This was a combination of decarbonization and building a wind farm. So basically what was going on here is there was existing coal power plants, and the country had already agreed that all the coal power plants would have had to be retired. But now the issue was, how can you persuade the organizations that are maintaining and operating the power plants to retire them early? Because of course, for ENGIE, it's not very profitable to retire a functioning coal power plant that is net profitable early, right? And so what IDB Invest came up with here is a mechanism whereby they were rewarding ENGIE for retiring the power plants early through reducing the interest rate on the loan that they gave for this Kalama wind power farm. So it's a little bit tricky again. I'll show you the diagram of what they did. So basically, IDB Invest gave them a senior loan that was priced at market rates. And then they got some senior co-financing as well at market rates. And then they used the Clean Technology Fund, which is part of climate investment funds. They used that money to disperse on concessional terms. And so the concessionality of this clean technology tranche, that is where the reward for retiring the plants early came in. And they had to come up with a methodology to calculate the carbon emissions that were avoided by retiring the plants early. And so that was a first of a kind. So they had to literally come up with the methodology from scratch. And then they applied it and calculated whether how much of the emissions were actually avoided and how much to reward ENGIE. Now, in all this, what was really interesting is that ENGIE said eventually, but wait, what if a carbon emissions trading scheme emerges? What if I would actually be better off if I sold those carbon emissions avoided on the market rather than applying them to this IDB scheme? And so IDB said, okay, fine, we'll write in the contract that in case there is a carbon emission scheme, you can decide if you want to sell the emissions on the carbon market or you apply them to us right away, right? And so they left that open, and they said it's at the sole discretion of ENGIE to decide whether they want to apply the carbon credits towards this loan and reduce the interest rate, or whether they want to generate revenues by selling it on the market. And so I really like that aspect of the transaction, because in this climate environment and with the carbon trading markets being not so established, it's really hard to foresee what will happen. And also nobody knows what the price will be of carbon, right? And so by leaving that open, they really made ENGIE to be the player that can make that decision. What's also noteworthy is that ENGIE, being a very credible and multinational firm, they had a strong balance sheet and they were fine taking on the loans for the Kalama wind farm. So in this case, they did not have to give concessional money for the building of the wind farm. The only reason they got a reduction in interest rate was because they decommissioned the plants early. And so this is an example for decarbonization in Chile. There's other examples as well that do this, but in the end, the decommissioning took place about 29 months earlier than planned, right? So that's the amount of time that they were able to accelerate it solely through embedding a reward or a subsidy for early retirement. This is the project impact in numbers, is a complete exit of the 90 employees that were employed in that in the coal mines. As in the power plants, there were, I think 30 people ended up working at the wind farm through reskilling. So they did that as well. 30 people took early retirement and 30 people took, leave and found some other employment elsewhere. And so they did this, the training courses, the reskilling was part of the transaction as well. It was a lot of new investment that they were able to mobilize from IDB Invest and from the co-financiers as well. There is a case study on all this. So if you want, you can dig deeper into how they calculated the carbon mitigation credit and so on. I don't think we need to go into this. But basically, the idea is that it all gets applied to the repayments, but only at the end of, so at the bullet repayment point, basically. So that they didn't have to do the calculations all the time. They just said, okay, let's keep track of how many emissions avoided and how early we were able to retire, and then we'll do the final calculation at the point when the loan is due. So, to recap, these are the archetypes. We just saw a few examples for each of them. Now, what I would like you to do is think about where does your development bank fit in, and what have you seen in the market, and what is really important to you. I have some guiding questions here for you. What I would ask is that you get together in groups of 4 or 5 people. So maybe the one sitting in the front can just turn around, and then the ones in the third row can also turn around to combine with the people behind you. And I would like you to take 15 minutes approximately to answer some of these questions. You won't get through all of them, but who of you has been participating in a blended finance transaction, and what was your role? What factors are limiting the use of blended finance in your particular renewable energy market in your home country? And then which of the financial instruments covered have you used in the past? And then if you have been involved, then feel free to also describe the blended finance transaction to your peers. All right, so the front can turn around and then you can have discussion groups. I'll leave the questions up here for you.
So in our group, we had some experience from the Netherlands, where renewable energy is I mean, a lot of small projects, but also some large projects in renewable energy, all require some blended finance components. The main reason for blended finance to be used is to support these projects that suffer from curtailment and negative price in the market. Also, blended finance is used to support the development of storage, which is actually a technical solution to those issues that the renewable energy plants have in the Netherlands. I don't know if there is another thing to add. In terms of instruments, they use a lot of guarantees, but they have also sometimes subsidies to support these projects. On my side, I shared a few projects that I've seen in Africa. The first one was in Tunisia, where the Tunisian government launched the first renewable projects in 2016. They reached, they were signed, or the PPAs tariffs were set just before COVID. And I think everyone knows that COVID meant a lot of inflation, so those tariffs were not sustainable anymore. And none of the projects reached financial close for more than 1 year. And then, so when I joined Proparco, I was on the second project that reached financial close. And this project, actually, one of the reasons they managed to reach financial close was the use of blended finance. We had EBRD in the project. They managed to mobilize 2 tranches with very low, very concessional rates that helped to reduce the all-in rate for the project. And also the developers, they managed to mobilize a grant from the Japanese government that also helped them reach a positive return on the project. Another project that I saw was a transmission line between Zambia and DRC. And here the issue was that during the structuring of the project, we saw that taking into account the market risk was, the consequence was a high level of DSCRs. We needed a lot of cash to cover the risk of the market, which was not sustainable, especially in these countries where the credit risk is also not great. And one way for us to mitigate those constraints was to add a blended finance tranche on a junior tranche, maybe to link to what we discussed yesterday. And this junior tranche helped both to reduce the cost of debt and also to have less constraints on the DCR.
Yeah, that ratio of capital that you have to hold in account for that project, that's a really important constraint, right, for some of the banks, because it really determines what your internal cost calculations are, and it might just be too expensive. Like the credit committee would say, why would I do this deal when it's not really yielding us anything? And so there, blended finance can really make a difference as well. From this group, maybe one person?
I think in our group, we just various forms for question one. One has been, I think, more funders providing, i.e. credit lines to institutions to then on-lend, where the funders, consistent funders aren't taking the project risk, versus where you have for DBS experience, where you have a GCF, where you set up a blended finance facility as well, which is structured for different tranches, subordinated debt, junior equity, and which from a junior equity perspective, I think from our perspective, what we said that it really has also a positive impact in that we can fund SMEs in the whole transaction structure. I think my colleague will talk to that bit, and also community trust as well. I think so. Those are kind of transactions we're kind of seeing. I think question two was quite interesting. I think from a KfW experience, what they're doing as well is, I think, the use of guarantees, the leverage effect of guarantees, unfunded guarantees. I think it's something we need to really explore, and yeah, because that also I think from a reporting perspective, they said that you don't have to actually report as much using guarantees. I know that within blended finance, expected concessionality, the pricing is concessional, but it's not actually cheap. Yeah. It's actually from an administrative perspective quite expensive, yeah. and asking your borrowers, asking your co-funders, they ask you, why do you need this? Why all the time in your loan negotiations? So it's quite difficult, but it's a learning curve. So hopefully in the next 5-10 years, just be simple. But yeah, I think for use of guarantees and how we can sort of but make sure that all our funders can report more. And then where do you see the biggest potentials? Yeah, so I think I've answered that. I think for us is from a guarantee perspective. I think for us, our experience, I'll just talk to you our experience as DBSA, when we set up these blended finance structures as well, or facilities, especially working with the Green Climate Fund, has been, a lesson learned has been technical assistance needs to be part of the blended finance structure, especially if you're really targeting the smaller kind of projects. How you provide technical assistance, project preparation. Sometimes the project sponsors, the local project sponsors do not have the funds available for the project preparation. Accessing funding from DBSA, accessing funding from all banks is an expensive process. All those funds have to be paid by the project sponsor. So I think really we would really, and we are incorporating currently in our blended finance structures that we're setting up currently for the adaptation sector. As DBSA, we're really putting a technical assistance component to really unlock and make sure that, because infrastructure takes long anyway to prepare, but if we have those available fundings you can access, it really helps in getting those projects to reach financial close. So hope I've answered. I was just having coffee there, but I hope I've answered you.
Thank you very much. Yes,
Thanks.
on the technical assistance, sometimes what happens is when you've brought on board a DFI like KfW and you tell them, look, there's no way we can fulfill the reporting requirements, you can go back, and if you complain to the multilateral lender, sometimes that organization can then find the technical assistance for you, right? So in some cases I have seen it was KfW who had agreed already to provide the loan, and then the recipient was like, but there's no way I can get all that reporting done. And so then KfW internally goes to the ministry and says, I really need 1 million. It's not a big check, but it's really going to transform this project. And that's how it works, right? So don't you think that you need to be the one who swallows all those costs? And it doesn't always work, but if you signal that you have no capacity, that you really can't, push it down on the investees, then sometimes the lender can help. And I know it's the same for IFC, for example. They have pots. Of course, they will not offer you that on top of everything, because to them it's already a lot of stuff they are providing, right? But if you really ask, then sometimes there is a way to get that. And on the guarantees, yes, it's true, the leverage ratio is very, very high, because a lot of times guarantees are unfunded, which means there's no immediate outlay of cash required. So for the bank itself, you can cut 4 guarantees, you can enter 4 guarantees agreements, and the amount you have to hold in reserve is comparatively small if you compare it to, actually putting out concession equity or concession debt. Okay, in the interest of time, let's break here. Let's take some coffee and have some snacks, and then we reconvene at 11 o'clock for the panel discussion.
So we were discussing, blended finance, of course, in the renewable energy market, and not everybody of us had actually experience in the renewable energy market, but quite so, let's say, in other markets. From my personal experience, shared something. Then we also discussed the market in Italy a little bit, and insurance policies. And what we see in the Netherlands as NWB Bank, and this might be a bit of selection bias because we only attract project finance where there is some type of guarantee. We have, for example, always subsidies on our projects. So there's also some concessional debt, but not very often, because sometimes the project that we finance are quite small, so they don't actually need to be involved. And then we discussed also some issues with permitting within the renewable energy, which is also not really always the case. That's quite straightforward. And we discussed quite a bit. But
thank you very much. On the topic of permitting, that also actually came up in the waste to energy facility. That's why the Japanese company was so keen to work with the Vietnamese company, because the Vietnamese company had all the relations and knew how to get the permits. And that's something that the Japanese company would have not been able to do. And so that's where the local expertise of the Vietnamese company was really, really important.
We focused more on blended finance. We were blending concessional finance from climate sources. So, of course, renewable energy is certainly one market that we've targeted, through the use of that concessionality. But I think there will be a dedicated presentation from a colleague of mine around a particular embedded generation investment program. But I think we've definitely used the blended finance approach, especially with the likes of your UNFCCC mechanisms, in terms of getting concessional debt from them. We've tried in the past to also look at guarantee instruments from the GCF, but I think at that time, the guiding framework in terms of deploying guarantees wasn't, I guess from our perspective, mature enough for us to also, incorporate a guarantee instrument as well. So it's predominantly concessional loans, which we then blend with funding from us as a DFI. There is an expectation generally for the DFI to also match the GCF funding in the same tranche. So if it's subordinated debt, we also need to have a subordinated tranche, and we match 50-50 with the likes of GCF. And then there's obviously senior debt coming from commercial funders, but their funding would come in at a sub-project level. So typically we would use this blended, we would establish blended facilities or blended programs, and then support sub-projects either in the renewable energy sector or other, climate-related sectors. I think one challenge or limiting aspect in terms of, especially where you're mobilizing concessional finance from the likes of GCF, where you're receiving USD, is issues around local currency lending, which was a major issue for us. We spent quite a long time negotiating with GCF in terms of how the funds flow to the DBSA in order to manage the forex risk and hedge those funds. Because previously the structure that they suggested, we had to pass the risk to the project sponsors or the clients, and that definitely wasn't it wasn't amenable when we started implementing. So ultimately, we then agreed on a credit line for at least 2 of those programs, or blended programs that we've agreed with GCF. And then I think maybe my colleague from Mexico also spoke about, they also accredited to the GCF, but they haven't yet, deployed, that type of funding, but they have concessional finance from other multilateral development banks. Where it's either being used for sustainable transport as an example. So I think a lot of the MDBs do offer more concessionality for more sustainable type of projects. So we also have what we call a climate action credit line from EIB, where I guess you could describe that as a blended mechanism as well, where you blend that with other sources of debt as well.
Thank you. On the GCF accreditation, that is a major upfront cost, right, for you as a development bank. But I'm glad to hear that at least for DBSA, it seemed to have worked out in your favor. Because if then you get accredited, you can access huge amounts of concessional financing. While normally a lot of times the amounts that the multilateral development banks and donors give are relatively small, the GCF is the only one that actually gives sizable amounts of concessional capital.
One thing I forgot to mention, but which is quite key, is we saw the need for technical assistance as part of the blending. So normally with GCF, we've learned from the previous blended facilities that we've established to also have a grant component, which is used to prepare sub-projects and to take it to bankability for project preparation support. So we've seen that especially useful for not necessarily the renewable energy market, but certainly on the water sector, where a lot of these projects are still at a very early stage.
And on the foreign exchange bit, that's actually the biggest criticism of blended finance, because most of the money that is being deployed through blended finance mechanisms is in hard currency, either US dollar or euro. And that's incredibly unsustainable for the underlying borrowers, right? And there's very few examples. There's one KfW, Africa Local Currency Bond Fund, that's doing great work in local currency. There's a few other examples. And of course, you can buy hedging mechanisms like MFX or TCX, which is expensive, right? So it's really not great. And so in the end, a lot of the banks just end up passing on the currency risk downwards, which is not great. And so that's one thing that is still outstanding. The one thing around would be to mobilize domestic private finance through domestic blended finance solutions. And so that's something that we would like to see more of. Next group in the back, maybe.
Okay, so in our small group discussions, there's 2 different experience from PDSMI and from the Croatian bank. For us in Indonesia, it doesn't common. It's not common to have a blended finance that include the grants and guarantees and so on. So the blended finance, it's just 70% from the senior loan debt and the 30% for equity. And for the Croatian bank, you guys have the blended finance in grants, senior loan debt, and equity, right? Yeah, something like that. And what is limiting? In Indonesia, the limitations is usually we are so hard to get the grants for our transactions, financing in clean energy. So for us, we don't have any experience in blended finance using the grants, actually. And for the way out in our blended finance. Maybe we also ask the sponsors from our borrowers to inject capital and to maintain the self-financing equity portions to guarantees the loan debt. Actually, something like that. Maybe in the future, we hope that we can include the grants and we can expand our blended finance in other transactions.
All right, in the interest of time, we will move on, but you will have more chances to present from your group, and we will pick different speakers the next time around. So let's get into a market trends quiz. Let's look at the blended finance market first for aggregate financing in climate, right? So climate deals are marked in dark blue, while all deals are light blue. And within climate deals, it's important to know that the majority of them are mitigation related, which basically means renewable energy in this context, right? And so very little adaptation. So for now, if we're looking at climate, it's a very good proxy for renewable energy, unfortunately, actually. And so if you look at overall financing that flows to blended finance, if you compare it to the needs in countries, it's actually quite small. The average blended finance, annual market has been around 18 billion, which is not very much if you compare it to the needs. But of that, 80% flowing through to climate-related targets. And so within climate mitigation is the biggest one. And so if you look at the number of transactions every year, it depends between like 120 to 150 transactions every year, which is also not very much. But of course, it is sizable if you think about how long it takes for one blended finance project to reach financial close, right? It's usually at least a 3-year undertaking, even though everybody says, oh, we'll close in 12 months, and then 2 years later they are still trying to get together the pieces.
When you say climate finance, do you just include asset financing, or do you include climate risk financing, such as contingent loan facilities, even potentially risk insurance as part of the climate finance? So for the residual climate risks financing and so on and so forth, or is that really asset financing only?
Well, asset financing, yes. Risk financing, not really, because we haven't seen a lot of transactions in that space. And so it is really more on the asset side, through whether it's project financing funds, facilities, whatever, bonds, it can be anything. And this, because it's, I'm going to show you the overall market a little bit later on maybe, okay? So let's maybe pick that point up in a little bit. Let's look at overall blended finance. This now is any sector, any geography throughout. And what I want you to look at is the amount of true private sector financing compared to the development finance institutions. Because what happened last year was, for the first time, the commercial capital from private investors actually surpassed the financing from development finance institutions and multilateral development banks, which is a great sign. But still, if you think about overall blended finance, the development agencies, through their official development assistance, still account for 19% of all of it. And so if you compare then these two to what actually is mobilized, it's not very much. Because a lot of times what we are trying to get is that we are getting a multiple of what a concessional donor puts in terms of private capital. And as you see from these aggregate numbers, that's really not happening. Question?
Maybe one question going a bit back to the definition actually. So what we do as KfW as well, and I think AFD as well, is we also consider facilities or projects where we would blend grant financing with our concessional loans also as blending. But then this is, I understood now that this would not be considered blending in this regard, so also not in the stats before.
Correct.
And then here it would be, all just considered as part of the development assistant, right?
Correct, yeah. So for Convergence, what we have established for ourselves is that we focus on those transactions that have true private capital in them. So if a development bank blends some grant funding from the German government with KfW's own account money to us, that is not considered in these graphs because there's no true private organization participating. So even if the KfW was issued at market rate, we would still not enter it here because to us it doesn't count. It misses the point of mobilization. Official development aid has increased, and then like a few months later, US aid got taken apart. Then the Dutch announced decreases in their foreign aid. Then the Germans announced decreases in their foreign aid. So like by now the trend has reversed, right? So while we had a larger portion of official development assistance in 2024, we will certainly be reporting a much smaller portion of official development aid.
It's again the jump between 1.6 and 3 is again because they are in the same transaction as private investors.
Sorry?
The jump comes only because more of the ODA money is in combination with private sector financing.
Yes, but also there is another factor that contributes to that jump, and that is a change in the OECD rules for how they account for official development assistance. Nowadays, they also count guarantees as part of the ODA. Before they did not. And so overnight, basically, the development banks were like, perfect, we can meet our goals because we've issued so many guarantees, right? And so that's in part why this number is higher. Which is also in part why guarantees are now so popular everywhere, because all the people inside the development agencies are now like, okay, perfect, let's just do a guarantee because it now contributes to our percentage of GDP goal, right? And so if you ever find a development agency that before never mentioned guarantees and now it's really keen, then you know why, because the OECD changed its rules. But let's get back to what we are talking about. So basically, the private sector financing at market rate has remained stable, right, over the 2 years, and it's now finally surpassing the development finance institutions' contribution, which is a good sign, but it's still too small if you look at the overall ambitions of blended finance. What's also interesting to note is that we have seen a lot of very large-scale projects in the last year. However, as Laurent pointed out, those are very hard to replicate, right? Like doing a 1 billion transaction somewhere in Zambia does not necessarily mean that we can have 3-4 more 1 billion transactions elsewhere. So, it might just be that those are outliers in the system. What is noteworthy is that the median deal size rose from 22 million to 70 million in 2023 and 100 million in 2024. So that's a good sign, right? Because bigger projects normally means an easier way to mobilize private investors, because a lot of private investors, they have a minimum ticket size of at least 50 million, and they also don't want to own 80% of the thing, right? And so if you have those two factors of minimum ticket size but not owning more than 20% of the overall project, then you need a certain project size to get them even interested. Now, we said it's a quiz, so here's the first quiz question. Looking at the whole blended finance market, which sector do you think do blended finance transactions target most often? Agriculture, energy, or financial services? Energy? Energy, but not by much, right? Financial services and agriculture are also quite close, but energy is, with 28% of deals, the most common target sector. Financial services historically have been very strong because microfinance was one of the first sectors for blended finance to really take off in. What's also interesting is the median deal size is relatively large for energy transactions. Now let's zoom into the energy market, right? Let's look at only energy deals. Most of it is project finance. There's some funds, which includes the Mirova fund as well. And then there's some company level financing, whereby the company is the entity which takes the concessional loan or which gets the technical assistance and so on and so forth. But those companies are generally rather small, like Mkopa, Solar, or some of those smaller organizations. And then the energy deal size by transaction type is also largest for project, which is not surprising, I imagine, for you. Deal count has remained steady between 30 and 40 over the years, so pretty good number. But now let's look at some of the investors, and I think this slide will be very interesting to most of you. First of all, you see USAID's no longer there, right? So that means that blended finance is losing its most significant contributor to blended finance on the concessional side. I've noticed the top ones at the top, right? So like FMO has done the most deals in blended finance for energy over the last couple of years. Same here, Shell Foundation has done the most transactions, although Shell Foundation mostly does company level deals, not so much projects. So with USAID basically being out now, it means there's a big gap on the development agency and multilateral fund side. The good news is that some other organizations, like the Germans, are still there, right? The Japanese also do a whole lot. And then the private infrastructure development group is backed by a number of donors, including the UK and Germany and so on, right? And so that still stands. And then we mentioned the GCF earlier. GCF is a very, very common contributor. If we looked at the volumes, GCF would probably be higher. Right now I'm looking at frequencies of transactions. Yeah, so that I think if you look at volumes, then GCF might be even higher.
Maybe that's a German confusion, but what does our ministry actually, like how, by whom? Because
through
if it's not like
KfW.
KfW.
Through KfW.
Yeah. And DNG together, right?
So if you do first loss equity for a blended finance transaction, in our data, we enter it as BMZ, but it's actually KfW who administers the donor funding. Yeah. So all the first loss contributions that you do would be counting under BMZ.
Yeah, no, thanks. I think you mentioned the US aid. Our experience, I think, especially from project preparation, is that when you go for US aid, they want American companies, American consultants, etc. Are there those other instances with other blended sort of funders, investors, that you have to use their consultant, in-country consultants or Dutch consultants, etc.? Because it becomes a bit of a difficult, especially with our South African environment, where we have to really see how we can assist our consultants and our companies as well to be part of the transactions. Thanks.
My answer would be sometimes. Maybe KfW can comment on the German example. I do think there's a quota, no? Huh? Is there a quota for German companies or consultants being used in the projects? No, there's no quota?
No.
Good. Not yet. I think for GIZ there is a quota, but I think it's not on initial projects. It's more on like overall 10%. I know for Japan, like for example, this joint crediting mechanism that I described earlier in the other example from the Japanese company, that was only accessible because it was a Japanese company applying. Yeah, but I don't know so much for the other organizations. This one, for example, the Clean Technology Fund is funded by the Canadians, but I know this one does not have any strings attached. Yeah. The Clean Technology Fund is very, very common. So this is a very interesting example to look at. What I do also want to point out that in the end, who we are trying to get in are these guys here, right? It's the banks and institutional investors. That's where the money lies. So, all these are just helping in blended finances world to bring in these, right? And so if you look at who is the most involved banks and institutional investors, MUFG is leading the charge. They are also working on an adaptation fund that will fund public entities called Gaia, together with climate fund managers. That should be a very interesting one for some of you to look at on the nature-based side. Standard Chartered, Societe Generale, Sumitomo Mitsui Banking Corporation, and Standard Bank are also amongst the top. Yes, please.
Another question, why do you mix real impact investors that are investing in funds and fund managers like responsibility together? Mirova, they are not investing their own funds, right? Senyat, Calvert, they do bring funds, and so they should be, yeah.
Well, where would you put them? You would create a separate category?
Managers, but they are not impact investors, right? Responsibility is not an investor as such.
Well, yes, because the funds that they have, they then invest.
But Calvert invests into responsibility just like
sometimes. That's right. But Calvert also does direct deals. So our database captures both. If Calvert supports a transaction directly, we will count that as one deal. If Calvert puts money in Mirova, we will also display that in our database. So it's true. It's a very good point you're making, because these guys don't have their own money. Like, they're not the same as Calvert, so to speak, but Mirova raising 300 million means Mirova is deploying 300 million in impact investment capital into the blended finance market. And so your point is also on double counting. So we have to be careful in our database that we don't look at the money twice, which we look, right? Like, we are very careful not to double count. But it's true, sometimes it happens that, for example, a German impact investor will put money into Mirova, and then Mirova will, so we record that as a blended deal on the fund level, and then Mirova will participate in some electricity or e-mobility transaction, and that will still be recorded in our database. So we do, for the investees, we want Mirova and responsibility to be displayed here, because some organizations use our database to find who they can ask for money, and then they can ask Mirova for money, because Mirova cuts checks on market rate terms, but with an impact objective, which is exactly what an impact investor does, right? So that's why we have them here. But it's true, I guess we could create a fund manager category, but then you would have a lot of different ones, like Blue Orchard, like Finance in Motion, like all these other guys would then also show up. We talked about foreign exchange risk a little bit earlier. Now here is the challenge with mobilizing local private investment. It continues to be underrepresented. If you look at this slide earlier, there was only one regional development bank, which is the African Development Bank here. Asian Development Bank is also here, but those are really the only ones, right? So we would like to see more of the regional, the local, the domestic ones. Even like the Nigerian pension fund, right, should be on top here, because the Nigerian pension, and the sovereign wealth fund also has a lot of money at its disposal, but it's not flowing into these transactions at the moment. And so that's a challenge right now. Some of the barriers that we have observed, one is a maturity mismatch, sometimes whereby the local banks rely on short-term deposits and are unable to provide the longer tenured loans, especially for infrastructure, right? You're looking at 10 years minimum, and with the construction delays, 15 years is better, right? Like you never know what happens on the ground with permitting and everything. And so that's a big issue. And then the counterparty limit sometimes also prevents local banks from investing larger concentrations. And then institutional investors generally rather prefer public markets and fixed income government securities, which makes blended finance transactions look like not such a good deal in comparison to those. And then a lot of the local investors don't yet have climate-aligned or SDG-aligned mandates, which means that all the impact that you're trying to prove with each project just doesn't really matter to them, because nobody will ask internally whether that's even interesting. And so if we want to mobilize more local private investment, then we need to first work on the enabling environment through local blended finance initiatives and also South-South collaboration. Yes?
I just wanted to comment on your previous slide. I find it interesting that you have Standard Bank there. Because our experience with funding alongside Standard Bank is they often sell down. Quite quickly, even during construction, to the institutional investors. Often even, I remember there was a project that we funded alongside them, and we were doing a restructure on the project because they had negotiated a longer PPA term and we could extend the debt and so forth. And at that point, it was even less than a year. At that point, they had already sold down quite a huge chunk of that. So I question the intentions as well, with them being there and looked at as a big supporter of blended financed energy projects. I just kind of question that.
A good point, very good point. So Standard Bank has a lot of branches in many different countries. It's very common, right? And that makes them, be very close to the projects and be very close to the transactions taking place. And I think that is in part what makes them also appear there. Same for MUFG, right? MUFG has a bunch of branches everywhere. Standard Chartered is another one that also has similar starting conditions that are more favorable, right? But you are right. In the end, and honestly, like Convergence literally just collects the data at the time of financial close. So we would not capture the selling down, which might be an issue, right? Because you would want to also look at that. But it's already tough for us to find the data on who were the banks that participated in the first place. It's even tougher to then monitor who did what after financial close. But yes, point taken, for sure.
Another perspective, because we all have our own experience, but I can't more than agree on your feedback on this partnership, because at least on our side at EBRD, what I would have done, I would have looked at the cost of funding of all the commercial banks, and then I would have discounted those who are, I know for a fact, not enjoying very good credit. Let's take SocGen. SocGen is struggling these days, no doubt. Compare it with BNP Paribas, their rating is far lower, then their cost of funding is higher, then they have to on lend at a higher rate. Then they will step in early on, but they can't keep the asset because they're making a loss almost on it. So in fact, all these guys, it's interesting to see where they're coming from. It's like, I guess, colleagues from KfW who commented on where the money is coming from. And it's critical because obviously whoever is funding them will also impose a dynamic to get in, to get out on a duration. And now a question for Regina, because it will make the connection with what we learned yesterday. Regina commented on the size of the deal, ticket size of 70 million, and I assume that in most of your country, it's big. Even more so these days, because regulators don't like 70 million convert into 100 megawatts. 100 megawatts, it's impossible to dispatch. I mean, you could have one plant. You can't have 10, because then the cost for the dispatcher is too high. As a consequence, on back to Regina, will it be not a room for colleagues to in fact structure a facility where you will already have not pre-blend, but already associated partners, and then you could be considering deals of 15 or 20. First benefit, you have a portfolio, then you mitigate the risk. Instead of being exposed to one developer, you are exposed to 5. And second, vis-a-vis your market, meaning the regulators on the electricity, it's far easier, because then you will have far many more initiatives, you see, arising at 50 megawatts. And is there initiatives among all these parties where, not that they pre-blend, not like, again, what KfW was mentioning, where you come with a facility which is already enhanced by some credit enhancing facility, then you have one deal, but you already come up with something else, more like a partnership of 3-4 institutions considering a new scheme in a given country. Is it something you have seen that could address this issue of ticket size?
So there is examples for this aggregation that you're saying. So aggregation is super important, especially if you're trying to get the real institutional investors involved. A lot of times, the way we capture them is if there is a fund established, so an SPV or some, some legal entity domiciled in either Luxembourg or Delaware or whatever, right? And so that fund then promises to support projects of a certain nature, let's say 50% solar, 50% wind or whatever, right? And then that fund goes and capitalizes itself from like organizations. And development finance institutions can be the ones who participate in it, right? But in your particular countries, I think the bigger issue might be that you might want to create a portfolio of local, like in-country projects, right? And so like you would do that for South Africa in South Africa only. And so thereby it would be more appealing to local institutional investors rather than international ones, because international ones will look at it and say, diversification. Like, can you please do Zambia, Uganda, and South Africa together, right? And that then becomes more than you would normally do. I mean, I guess you would still consider it because you can do business in other countries, but it just becomes a different animal, right? And so I think that making that choice, whether you are going to create a portfolio in country and then approach local investors, or whether you are going cross-country, like Mirova does, for example, for the benefit of diversification. That's an important one. But yes, like if you're trying to get the institutional investors on board, then creating a portfolio of investable assets and not just doing project by project is the right way to go. It's more efficient also in the long term, because each of these funds, most of the time they're closed-ended funds, the 10 plus 1 year, right? So a 10-year, 5 years of investment, 5 years of divestment. Like that just means that you have, a whole more leeway and can do more things and had only to fundraise once, right? So it is more effective, yeah. We don't have much time left. let's move on. Which type of renewable energy do you think gets financed most frequently? You can just say the answer aloud if you think you know it. Yeah, there you go. No surprises here. So if we look at the numbers comparing 2018 to 2020 with 21 to 23, we have seen a drop in hydroelectric, which is interesting, and a further increase in solar. Wind is also coming, huh? Wind by now is 25%, which is not bad, but yes, solar is still leading. Geographically, overall, blended finance often targets sub-Saharan Africa with about 50%. People often ask why. That depends on where the donors want to put their money, right? And so if the Japanese and the Germans and US aid in the past were the ones who make that concessional capital available, if their strategy was to invest more in Africa, then that would translate to more blended finance deals in Africa, right? Because normally you have to secure the concessional capital first before you can mobilize. So it's not the institutional investors who say, of all emerging markets, I want to go to Africa. It's more like the investment opportunities that are sufficiently de-risked usually target Africa or are even global in terms of the portfolio. And the other thing is, a lot of people criticize blended finance for not being a good approach in least developed countries. That is very true. Blended finance is not a very good approach for least developed countries. As you see from here, it's more in the lower middle income countries where blended finance is a good tool, and that goes back to the regulatory environment, right? Like for private investment to flow, the country needs to have a certain rating, credit rating. A lot of times they actually say we cannot go beyond Kenya and Uganda, for example, because those are the only countries where we get this through our investment committee and through our risk committee. And so in the end, blended finance is a better tool for countries where the framework conditions are already ripe enough for private investment to flow, especially cross-border. And that's fair, right? Like, because in least developed countries, we can use traditional normal grant funding, like humanitarian aid, right? Or like a straightforward BMZ grant can go to those areas. But if we can manage to bring in more private finance into those lower middle income countries, that frees up grant funding that can then go to the least developed countries. Next question, what are the top target countries for blended finance in renewable energy? What do you think? Kenya receives the most, this is frequency again, huh? of energy deals. Kenya received the most ones in the past years. India is following closely, but if you look at the whole list, India is the only, like, okay, Indonesia has made it, but India and Indonesia are the only Asian countries in this list, right? Like all the other ones are African, which is really interesting. Indonesia, that's also due to SDG Indonesia 1 and some work that PTSMI has done. So you've really, like before it used to be all African except for India, now it's India and Indonesia. I guess we've already had a lot of questions, but if there's any more questions, you can ask them now. After that, we'll do the group work again. Is there any questions, comments?
Maybe just one, I guess, comment. Is it fair to say that if you're blending, let's say, a highly concessional source, those type of sources or funders would have more reporting requirements? I mean, the likes of the GCF as an example, because that's sometimes a challenge in terms of then imposing those conditions or reporting requirements onto the private funders as well. I think with renewable energy, reporting on the mitigation potential isn't as a major challenge, but I think it's more the other requirements that they have, whether it's doing a gender assessment, gender mainstreaming, getting that data in place. So I think that's where we've had to kind of sensitize, the commercial lenders to say, look, if you want this concessionality as part of, supporting these projects, it does come with these supposedly onerous, reporting requirements.
It is a very good point, and yes, generally, the more, especially of the public lenders you involve, the more different reporting requirements will have, because most of them are not all aligned in one framework. There's very little examples where the development banks got together and decided, okay, these are the KPIs we both want, and we are going to limit ourselves to that. A lot of times, the KfW will have different ones than ADB, and GCF will have yet another list that's like double the size, right? And so that is a big burden, because in the end, you need to get the data from the project. It's not like you can just write it up in your office, right? And so that is where the technical assistance comes in, because a lot of times, especially also from GCF, you can access additional grant funding to try to engage, whether it's engaging a local consultant to develop the numbers, or also writing up the gender action plan, right? So it's really important. The more organizations you have involved, the tougher the reporting becomes. There's one initiative now from the Germans, amongst others, Scaled, which is a blended finance company that will try to prepare big funds that will have only one reporting framework for all of the organizations involved, including institutional investors like La Caisse, CDPQ from Canada, and Allianz, for example. And so that initiative is trying to pick up on that point of trying to have only one reporting framework that all the funds that they end up incorporating have to follow, but it's not yet the norm. Yeah. And I think it's something to be aware of, because while you're doing the structuring, you can still push back. But if you've signed everything, then you're bound, right? And so I think also for the local development banks, you are the ones who know better what the projects can deliver on, what they can't, right? So it's your turn to protect them against some of this. And I know with GCF it might be hard to argue because they literally have it written in stone. But with some of the development banks, you might have a little bit more leeway.